Friends, thank you for being here today. We stand at a precipice of economic history, a moment where the tectonic plates of global trade, national security, and monetary policy are shifting beneath our feet. For decades, the Western investment thesis has been predicated on the free flow of goods, globalized supply chains, and the assumption that the market determines the price of all things. That era is rapidly drawing to a close. We are turning our attention today to a development of profound significance, one that has largely flown under the radar of the mainstream financial press, but represents a sea change for hard assets. President Trump has signed a proclamation ordering negotiations to adjust imports of processed critical minerals. This is not merely a bureaucratic adjustment. It is the initiation of a strict 180-day countdown. The Commerce Department has formally warned that America's dependence on foreign supply chains threatens national security. This proclamation places silver and copper, formerly viewed merely as industrial commodities or monetary hedges, squarely into the realm of national defense assets. With price floors, trade negotiations, and potential Section 232 actions now firmly on the table, we must ask ourselves, why now? And more importantly, if negotiations fail within this 6-month window, how will the implementation of government-mandated pricing structures fundamentally alter the valuation of domestic mining assets compared to the manipulated global spot price? Today, we will dissect the data, analyze the geopolitical maneuvering, and outline why the next 180 days may be the most critical period for the metals market in our lifetimes. I invite you to listen closely to the data presented, and I am very keen to hear your perspective on whether this marks the definitive end of free market pricing for metals. Let's dive in. Let us begin by deconstructing the executive action and the 180-day clock set in motion by the president. To understand the future of silver and copper, we must first analyze the mechanism the president has just activated. The proclamation orders the U.S. Secretary of Commerce and U.S. trade representatives to jointly negotiate agreements with trading partners immediately. The objective is explicit: to address the threatened impairment of national security regarding imports of processed critical minerals and their derivative products. This is not a suggestion, it is an ultimatum. The administration has set a hard deadline. If satisfactory agreements, those that ensure a secure, reliable, and price-stable supply of these materials, are not reached within 180 days, the president is authorized to take other actions. Historically and legally, this language points directly to Section 232 of the Trade Expansion Act of 1962. This brings us to a historical parallel that cannot be ignored: the return of Section 232. For those of us who remember the Cold War era, Section 232 is a powerful tool. It allows the president to restrict imports if they are found to threaten national security. However, in this modern context, the application is more nuanced. The administration is not merely looking to block foreign metal, they are looking to secure domestic viability. The Commerce Department OURS probe found that the present quantities and circumstances of imports threaten to impair national security. Specifically, weakened domestic production and a lack of access to secure supply chains affect the production of advanced weapon systems, energy infrastructure, and everyday consumer goods. This vulnerability leaves America open to exploitation by foreign actors, a diplomatic euphemism for China and its dominance over critical mineral processing. The 180-day countdown is essentially a negotiation period before the U.S. government potentially steps in to manage the market. It is a signal that the laissez-faire approach to critical minerals is over. The government is effectively stating that it cannot allow the free market to bankrupt domestic producers of strategic assets. However, the issue runs deeper than just mining. We face a critical choke point in processing. It is crucial to distinguish between mining and processing. While the U.S. has reserves in the ground, we have allowed our processing capacity, smelting and refining, to atrophy or move offshore. China controls roughly 85 to 90% of the processing capacity for many critical earth elements and a significant portion of copper smelting. The proclamation specifically targets processed critical minerals. This indicates that the administration understands the bottleneck. Even if we mine the copper here, if we have to ship it to China to be refined before we can use it in a submarine, we have not solved the security problem. The 180-day clock is ticking not just on raw ore, but on the industrial capacity to turn that ore into usable metal. This leads us to a fundamental question. Why are silver and copper being elevated from mere commodities to matters of national security? To the uninitiated, silver is a metal for jewelry or a store of value. To the military-industrial complex, silver is the lifeblood of modern warfare. The investigation highlights that a lack of silver and copper affects the production of advanced weapon systems. We must confront the military reality of silver's indispensability. We must look at the physics of the situation. Silver is the most conductive element known to man. It is non-negotiable in the guidance systems of Tomahawk missiles, in the circuitry of smart bombs, in the avionics of fighter jets, and in the burgeoning field of drone warfare. You cannot build a guided missile without silver. You cannot build a nuclear submarine without copper. In World War II, during the Manhattan Project, the U.S. government borrowed 4,700 tons of silver from the Treasury to use as conductors in the electromagnets for uranium enrichment because copper was in such short supply. They understood then what we are relearning now. Silver is a strategic material first and a monetary metal second. Today, the stakes are higher. A single Tomahawk missile contains 15 kilos of silver. As global conflicts heat up, the burn rate of these munitions increases. We are literally firing our strategic stockpiles into the air. If the supply chain from Mexico or Peru is disrupted, or if China refuses to refine the concentrate, the U.S. military machine grinds to a halt. Beyond silver, we must look at copper and the electrification of our defense systems. Furthermore, the transition to a digitized, electrified economy requires massive amounts of copper for the grid and silver for solar energy and electronics. The administration has correctly identified that reliance on foreign adversaries for these materials is a strategic choke point. Copper is the nervous system of the modern Navy. An aircraft carrier or a nuclear submarine is essentially a floating city of copper wiring. Beyond defense, the domestic power grid, which is currently strained and aging, cannot be upgraded without massive inputs of copper. The green energy transition, which involves EVs and wind turbines, is effectively a metal intensity transition. An EV uses 3 to 4 times as much copper as an internal combustion engine vehicle. If a conflict were to break out, and given the tensions in the Strait of Hormuz and the South China Sea, this is a non-zero probability, the U.S. cannot be in a position where it must beg its adversaries for the materials needed to build its defense systems. Thus, the national security designation is not hyperbole. It is a recognition of logistical reality. Now, let's examine the economic mechanism at play here, specifically the critical distinction between price floors and tariffs. This is where the analysis requires a sophisticated understanding of economic statecraft. The proclamation mentions the pursuit of price floors with allies to prevent predatory pricing and stabilize markets. We must distinguish clearly between a tariff and a price floor, as their economic impacts are vastly different. First, we need to understand the inherent flaw of simple tariffs. A standard tariff is a tax on imports. If the U.S. puts a 25% tariff on imported silver, the price for the consumer goes up. While this discourages imports, it does not necessarily guarantee the viability of domestic mines if the global price collapses due to manipulation or dumping. Tariffs are a blunt instrument that can lead to retaliatory inflation without solving the underlying supply deficit. In contrast, consider the power of price floors, which could create a new paradigm for strategic metals. A price floor is far more aggressive. It is a form of corporatism, a merger of state and corporate interests for national preservation. A price floor acts as a de facto demand subsidy. The government, or a consortium of allied nations, think a NATO for metals, agrees that the price of a strategic metal will not be allowed to drop below a certain level, e.g. $30 or $50 per ounce for silver. If the global market price drops below this floor, the government effectively becomes the buyer of last resort, stockpiling the metal for the strategic reserve. This ensures that domestic mining companies can plan their capital expenditures, CapEx, with certainty. They know that no matter what the paper markets in London or New York do, they will receive a guaranteed price that covers their cost of production and allows for a healthy margin. This represents a significant corporatist shift in American policy. This policy implies aggressive stockpiling of above-ground supply and infrastructure investment. It signals that the U.S. government is moving toward ownership of market pricing power. It is a rejection of the race to the bottom, globalism, and an embrace of strategic protectionism. This is not unprecedented. We have the Strategic Petroleum Reserve, SPR. Why do we not have a strategic silver reserve? In fact, we used to, but we sold it off decades ago. The 180-day countdown suggests a move to rebuild it. I want to pause here and ask you, is this type of government intervention necessary to save our industrial base, or do you view this as dangerous market manipulation? This is a controversial topic, so I'd love to read your stance in the comments below. The result of these policies will likely be the creation of a bifurcated market. The implication for investors is the creation of a two-tiered market. We may soon see a global spot price, which may remain volatile or suppressed, and a protected domestic price, which is higher and stable. Domestic silver and copper, sitting within the secure borders of the United States, effectively become a premium asset class, insulated from the predatory pricing tactics of foreign entities. While Washington prepares its strategy, we are already witnessing a profound global disconnect between Shanghai and the West. While the U.S. administration prepares its 180-day countdown, the global market is already fracturing. We are witnessing a historic arbitrage opportunity and a divergence that signals the breakdown of the single global price mechanism. This disconnect is most visible in what we call the Shanghai Premium. Data from the Shanghai Gold Exchange, SGE, reveals a startling reality. Why this discrepancy? The Shanghai market is far more physically oriented. When a contract is bought in Shanghai, there's a much higher probability that physical metal is actually changing hands. In contrast, the Western markets, COMEX LBMA, are dominated by paper derivatives, bets on the price of silver rather than purchases of the metal itself. Make no mistake, the squeeze is firmly on. This price gap draws physical metal from the west to the east. It acts as a vacuum, sucking available inventory out of London and New York vaults and shipping it to China. This is exacerbated by China's recent move on January 1st to implement export controls on silver. Connect the dots. China restricts exports, keeping their silver, while simultaneously bidding up the price of silver within their borders. 2 weeks later, the U.S. president signs a proclamation to secure critical minerals. This is not a coincidence. This is a tit-for-tat escalation in a resource war. The 180-day countdown is the U.S. response to China weaponizing its supply chain. This signals the end of arbitrage as we know it. Normally, arbitrageurs would buy low in New York and sell high in Shanghai, eventually closing the gap. But with export controls and supply chain friction, that arbitrage is breaking down. We are seeing the formation of separate liquidity pools. If the U.S. implements price floors, we will have a third pool, the strategic security price. I am curious to know, do you believe the Shanghai price is the true price of silver, or is it just another anomaly? I'd be interested to hear your perspective on this east-west divide. Closer to home, we are seeing flashing signals of domestic shortages in what I call the paper trap. Closer to home, the signals of physical stress are becoming impossible to ignore. We are seeing a classic disconnect between the spot price on the screen and the reality of acquiring physical metal. The evidence points to a severe physical drought in retail availability. Reports indicate that the U.S. Mint has halted sales of silver eagles and pulled numismatic inventory. Major retailers like Costco have placed restrictions on purchases. When the producer of the sovereign coin of the realm halts sales due to market volatility or shortages, it is a primary indicator that the supply chain has broken. In a functioning free market, a shortage leads to an immediate price spike to destroy demand. However, in our current managed market, we see the paradoxical situation where physical metal is scarce. Yet the paper price can be smashed down by 3% or 5% in overnight trading. In response, we see the CME Group offering a solution that looks more like a diversionary tactic. Perhaps the most insidious development is the CME Group's launch of new, smaller 100-ounce silver futures contracts. On the surface, this looks like increased access for retail investors. However, the fine print reveals the truth. These contracts are financially settled. This means that upon contract expiration, no silver changes hands. The winner receives fiat currency. The loser pays fiat currency. This is a purely paper instrument designed to divert investment demand away from the physical market. It is a pressure relief valve for price, allowing speculators to gamble on silver without actually taking an ounce of metal off the market. For the prudent investor, this is a trap. It is a mechanism to dilute true price discovery. If you cannot stand for delivery, you do not own the asset. The introduction of these contracts at this specific moment, during a physical shortage and a geopolitical crisis, suggests an attempt to manage the optics of the price while the underlying physical inventory continues to drain. Question for the stackers in the audience: have you tried to source physical metal recently? Are you seeing these shortages or premiums at your local dealer? Please share your on-the-ground experiences below so we can track the real inventory situation together. Given this landscape, we must ask, where does the investment opportunity lie? I believe the answer is found in the miner multiplier. Given this landscape, a 180-day countdown to government intervention, price floors, and a disconnect between physical and paper markets, where does the opportunity lie? While holding physical metal is the ultimate insurance policy against currency debasement, the current policy trajectory creates a unique asymmetric opportunity in mining equities. Let's look at the specific case for domestic miners. If the U.S. government implements price floors, the fundamental business model of a U.S. dollar-based silver or copper miner changes overnight. Currently, miners are price takers. They are at the mercy of the volatile spot price. If silver drops to $20, they lose money. Under a price floor regime, these companies effectively become government-sanctioned utilities or defense contractors. If the floor is set at a profitable level to ensure national security supply, the downside risk for these companies is legislated away. We are looking at a potential re-rating of the entire sector. Future opportunity lies less in the metals themselves, which will rise, and more in small, well-run mining companies with proven reserves and, crucially, limited capital access. Furthermore, these companies are likely to benefit from a massive subsidy tailwind. To secure this industry, the government must do more than set a price. They must subsidize. We can expect financial leverage to be granted to these firms: low-interest loans, grants for infrastructure, and tax incentives. This financial leverage creates operational leverage. If you own the right miner, one with deposits within the safety of the U.S. or its closest allies, you get the metal effect, appreciation of the underlying asset, plus the tailwind of government intervention. This is the miner multiplier. It is a return to a mercantilist economy where the state picks winners to ensure survival. In this environment, the miners are the winners chosen by necessity. Within this sector, it is crucial to distinguish between developers and producers. Within the mining sector, we must distinguish between producers, who are mining now, and developers, who have metal in the ground but no mine yet. The 180-day countdown puts a premium on near-term production. The government cannot wait 15 years for a new mine to permit. They need metal now. Therefore, existing producers and advanced stage developers with permits in hand will likely be the primary beneficiaries of any Section 232 funding or price floor guarantees. We must also widen our aperture to view this through the lens of the monetary endgame, specifically the confrontation between the BRICS nations and the dollar. While the 180-day countdown is explicitly framed as an industrial security measure, we would be naive to ignore the broader monetary war playing out in the background. We are witnessing the weaponization of commodities in a struggle for global reserve currency status. The actions of the current administration are not operating in a vacuum. They are a direct countermove to the strategies employed by the BRICS alliance: Brazil, Russia, India, China, and South Africa. For the past decade, these nations, led by China and Russia, have been aggressively accumulating physical gold and silver. Why? Because they are preparing for a post-dollar world where trade is settled not in fiat currency, but in hard assets. There is active discussion of a new BRICS trade settlement unit, potentially backed by a basket of commodities: 40% gold and 60% strategic resources like oil, copper, and silver. If such a currency unit were to launch, it would fundamentally remonetize silver. It would strip away the paper price set in London and New York and replace it with a valuation based on physical scarcity and utility. In this scenario, the U.S. cannot afford to be put short, the very assets that the rest of the world is using to back their currencies. The Trump proclamation can be interpreted as a defensive moat being dug around the U.S. dollar. By securing domestic supply chains and establishing price floors, the U.S. is ensuring that if the world returns to a resource-based monetary system, America still holds the cards. We are moving from a system of credit-based dominance to asset-based resilience. The 180-day clock is also a countdown to the U.S. getting its house in order before the monetary rules of the game change forever. This brings us to the inescapable mathematics of the industrial deficit, a reality that no amount of political maneuvering can alter. Beyond the geopolitics and the monetary theories, there's a simple, brutal math problem that the market has yet to price in: the irreversible deficit. Even if there were no trade wars, no BRICS currency, and no military tensions, silver and copper would still be facing an explosive repricing due to the sheer physics of demand. Consider the green transition and the AI revolution. These are not merely buzzwords, they are metal-intensive industrial shifts. A solar panel is essentially a silver sandwich. The global push for photovoltaics is consuming over 150 million ounces of silver annually, a number that is projected to rise as newer, more efficient panel technologies, like TOPCon, require even more silver loading per unit. Simultaneously, the artificial intelligence boom is a massive energy sink. AI data centers require vastly more power and cooling than traditional servers. This means more grid infrastructure, more connectors, and more copper. We are trying to electrify the entire global economy at the exact moment that ore grades at major copper mines in Chile and Peru are declining. We are entering a period of structural deficits. This means that for the foreseeable future, consumption will exceed mining production. In the past, above-ground stockpiles filled this gap. But those stockpiles, held in London and COMEX vaults, have been drawn down to dangerous levels. The 180-day countdown is an acknowledgement by the White House that the free market is not bringing new supply online fast enough. It takes 10 to 15 years to discover, permit, and build a new mine. We do not have 15 years. We have a deficit now. The only variable that can reconcile this equation is price. The price must rise high enough to destroy demand, make solar panels too expensive, or to incentivize impossible amounts of new recycling. The government knows this, and by setting price floors, they are trying to manage this explosion rather than let it destroy the industrial base. Before we conclude, we must address the technical analysis and the recent volatility, which appears to be a washout before the rise. We must address the recent market action. Despite the bullish fundamentals, we have seen volatility: gold down, silver down significantly in singular trading sessions, copper correcting. We should interpret this dip not as a failure, but as a psychological test. It is vital to separate noise from signal. Technical analysis suggests that these sharp dips, such as the recent move in silver down to the 89 range or lower, are washouts. They are necessary market mechanisms to flush out highly leveraged speculative positions, the CTAs and momentum traders, before the structural move higher begins. Markets do not move in straight lines. In every major bull market, there are terrifying corrections designed to shake out the weak hands. This is the wall of worry that the market must climb. Looking at the charts through a Fibonacci lens, retracement to the 50% or even 61.8% level, around the $82 mark for silver in this volatility band, is not a crash. It is a technical backfill. It essentially tests the conviction of the market. If prices dip to these levels and are met with aggressive buying, which we are seeing, it confirms that the smart money is accumulating while the weak hands are panic selling. The structure of the market remains dominant. The higher lows are holding. As long as we do not see a structural breakdown below key support levels, the trend remains intact. The volatility is the price of admission for the gains that lie ahead. As we bring this analysis to a close, remember that the clock is ticking. Friends, we must synthesize what this all means for our portfolios and our peace of mind. The Trump proclamation is not just another news cycle headline. It is the firing of a starting gun. The 180-day countdown has begun. We have 6 months before the U.S. government potentially alters the free market pricing mechanism of silver and copper forever. We are witnessing the end of the era of cheap imported deflation. We are entering an era of strategic inflation, where the cost of goods, specifically the cost of sovereignty and security, must rise. The government is telling us, in plain English, that they can no longer afford to let the market undervalue these assets. The divergence between the Shanghai price and the COMEX price is the smoke. The executive order is the fire. The shortage at the mint is the alarm bell. The strategy for the prudent investor is clear. First, ignore the paper price. Do not be shaken by intraday volatility or the introduction of cash-settled paper contracts. These are distractions. Second, watch the 180-day clock. Monitor the trade negotiations. If they fail, Section 232 actions will likely result in a rapid repricing of domestic assets. And third, focus on strategic value. Look at the miners that the government needs to survive. These are no longer just speculative stocks. They are components of national security. The world is resetting. The economic engine of the United States is being retooled from a consumer of cheap imports to a producer of strategic necessities. It will be a volatile transition, but for those who understand the script, it is a transition filled with opportunity. So I leave you with one final question. Where do you see the price of silver in 6 months when this countdown expires? Drop your prediction in the comments, and don't forget to subscribe for updates as we track this story. Stay calm, rely on the data, and prepare for the countdown. Thank you.